What's up, everybody? Welcome to Heresy Financial. This is the channel where we discuss financial topics in a way that is considered heresy to the financial establishment. I bring you the news, I bring you the education, and we talk about things that the mainstream financial news outlets are not talking about. We're going to dig in behind the scenes, see what's actually going on, and see what that means for you and how to protect yourself against the coming crash. Today's topic, we are talking about Americans, their debt, their savings, their plans, and how the data shows that most Americans are not actually prepared for a recession and how that's going to make things even worse. Let's dive in. All right, so it's no surprise that most Americans feel particularly stressed and stretched thin financially. Now, I want to make a note here before we dive in. I understand that there are two big contributing factors to most Americans not being financially prepared. There are probably a lot of other factors, but the main two, I understand that a big part of it is personal responsibility, because ultimately everybody is responsible for their own financial well-being. And the people that are, kind of getting more into debt, spending more and more, saving less and less, a lot of times if you change your habits, you can turn yourself around, you can educate yourself more, you can try and apply yourself harder, get better jobs, increase your income, spend less on things you don't need, save more, invest more. There are little things that almost everybody can do, and so a huge component to what we're talking about today is individual responsibility. But we don't want to ignore the elephant in the room, that the entire system is kind of established and poised to make it more and more difficult for the average American to get ahead financially. And it's only increasing that way. And we'll talk about this, but the main driver of that is inflation. Because as the purchasing power of American money is dwindling away and basically being stolen from the American people to finance government spending, that makes it more and more difficult for the good choices that Americans make to have good impact. And so it makes it more and more difficult as time goes on for the average American to get ahead. And so, yes, there is individual responsibility going on here, but the things that our government is doing and the Federal Reserve is doing is making it more and more difficult for those choices to have meaningful impact. So without further ado, let's dive in here. We've got some fun statistics today. I'm right now looking at a chart from NerdWallet. Now, NerdWallet, if you're not familiar, they do a lot of stuff with credit cards and debt, and so they have these statistics. The chart I'm looking at is from June, so it's just a couple of months out of date here, but these numbers should be still pretty close to accurate. Right now, when you look at all debt, the average American household, when you consider all debt, the average American household is $136,000 in debt. Now, yes, that includes mortgages. And so, that's still, though, with $136,000 debt, that's not all mortgage, because the average American, if you look down the rest of the chart, the first thing that we look at is almost $7,000 in credit card debt. Now, that's huge, and that's important because that's revolving credit card debt. So that's the balance that carries over from the month to month on average for the average American. So that is not, the balance that's paid off each month, because I know a lot of people who are, trying to be financially savvy. They'll use a credit card, try and earn some points, and they'll pay off the balance every month so they don't pay any interest. Little side note, you always spend more when you use a credit card, because when you use a credit card, it activates the pleasure centers in your brain. When you use cash or debit card, it activates the pain centers in your brain. They've actually done MRI studies with spending money, and so it feels better to spend money on a credit card. It feels worse to spend money debit card or cash, and so you end up spending less money. So the points that you gain from the credit cards are usually not enough to make up for the extra money that you spent. And so people who think they're getting ahead with credit card points, even if they're not paying interest, usually they're not. Usually they're just spending more money on things they don't need. But that's a side note. The average American household has $7,000 revolving credit card balance. So, that's not huge. If that was the only thing that the average American had, But the sad thing is it's not. And when you add that on top of things like student loans and your house payment and your car payments, it just makes the entire thing really difficult to handle. Those payments, the high interest rate that credit cards carry, that just makes that $7,000 balance look like something that's going to be very difficult to pay off when your monthly payments are, $100, $150, $200. It takes a really long time to pay down those balances, and so that's why they're there. That's why the average American has that debt load there, because as we're stretched thin, the median household income is $56,000 a year. You have to, you've got expenses come up, and we're going to see later the savings rates. Nobody has savings, and so that's pushing people to use debt for expenses, and so those balances are building. And if I'm not mistaken, this is at close to an all-time high or at an all-time high. The total amount of credit card debt for consumers in America, it's getting really out of hand really fast. The next thing that we look at, mortgages, $188,000 on average for the average household for their mortgage balance there. So not too surprising with that number. The next one that we're looking at is auto loans. So this one's surprising, $27,000, almost $28,000 in auto loans. So that's a huge number. That means the average American household owes more on their car loans than half their yearly income. That's enormous. I think the September or the August stats showed that the average car purchase price was $35,000. So people are buying cars that are way more expensive than they can afford. So that is one area where I'm going to talk about personal responsibility, because you drive down the road, I've talked about this before on past videos, every car that you drive by is a brand new car. You see Mercedes, BMWs, brand new sports cars, luxury cars everywhere. Even the more budget cars like Chevy and Ford and some of the lower priced cars, they're getting more and more expensive, and people are just buying the new ones left and right there. So we're seeing a lot of people get into car debt, and a lot of that has had to do with the low interest rates that we've had, as the Fed has kept the interest rates low in America since the recession here. So people have thought, hey, well, why not? The interest rate is really low, so I can afford the monthly payment. But we're also seeing those car loan durations increase. So people are going to 6 years, 7 years, sometimes up to even 10-year time periods on their car loans. And so it's just outrageous the amount of debt that the average American is getting into with cars, because all things considered, if you know much about cars, you know that cars that are 15, 20 years old today are very reliable compared to cars that were 15, 20 years old 20 years ago. The quality of cars has just increased so much over the last few decades that you can drive a car to 200,000 or 300,000 miles easy when you look at some of these these higher quality car brands, and you can buy them for really cheap, especially compared to new cars. So that's an area where I'm going to look at personal responsibility here. And then the last one here, student loans. Now, the average American right now, American household, $46,000, $47,000 student loan debt. So this is one of those things, again, I've talked about this before, and everybody's talking about this, how much of a problem this is, but this really comes back to, I think this is the government's fault here. Because prior to the government co-signing, basically, the government guaranteeing student loans, college tuition prices were extremely low. Because a college student is one of the worst people to loan money to when you think about it. They've got no job, no skills, no income, and no assets. And so if you loan them money, the chances they're going to be able to pay you back that money are very low. Now, if they get a good job after college and if they make good money, then yeah, they'll be able to pay that back. But the credit risk, when you look at it from a logical perspective of a college student, is extremely high. And so student loans, those were not a big thing for a very long time. And so the average person couldn't afford college. And when they could afford it and they went to college, or they just paid for it, while they went through it, it was worth something. It was valuable. It was kind of something that not that many people had. It was more of a rarity. But the government then stepped in and they said, hey, we're going to guarantee student loans. That way more students can afford to go to college. Well, what does that do? Whenever you have a cosigner on a loan, it's really the cosigner that is going to be paying off that loan from the perspective of the lender. That's why, when you have to get a cosigner on an apartment or on any sort of loan, if you default or if you miss a payment, the first person that they call is not the person who is listed first on the loan. They call the cosigner first, because the reason you needed the cosigner in the first place is because the person who is on the loan first was not actually creditworthy. The cosigner is. And so all these companies realized, hey, Uncle Sam is backing up these loans. They're guaranteed. I can't lose. So all of a sudden, student loans became rampant. So everybody was trying to loan students money because guaranteed, it's free money. You're guaranteed to get your money back plus your interest. And so once the colleges and universities realized this, they're like, hey, this student could afford our school last year on his own money, but now he has debt available to him. And so now we know for sure he can afford to pay a little bit more. And so they raised their prices. And every single university started doing this. And it's just been a slow tick up in prices and costs. And the cost of college and university has increased exponentially. It's outpaced almost anything else in our economic growth here, the cost of tuition. And every year that it goes up, the student loan capabilities get higher and higher, and colleges and universities, and when grants come in as well, grants coming in to pay, not just the loans, the actual grants from tax money comes in. Hey, if this student is getting $2,000 in free money from the government, and he could afford our college last year, we know that he can afford to pay $2,000 more this year. So all the government help does is make the cost go higher. Anytime you have subsidies and government's paying for things, all it does is it bids up the price. That's the only result. And so what you have now is tons of people that wouldn't have gone to college before, going to college now, getting degrees that are useless, and a lot of times they're even dropping out of college, and so they're going into a lot of debt, and then they're not even coming out with a degree. And so we have a massive student loan problem. I won't go any further into it because I could keep on going for a while, but the value of the student loan is going down the value of the degree is going down while student loan debt continues to increase. Everybody realizes it's a problem, but the solution is not more government, it's less government in this particular area here. So, I feel for students here because, usually when you're that age, you don't have a good handle on financial education. You're not that financially savvy. You don't understand, what that amount of money actually looks like. You don't understand, hey, if I graduate with $50,000 debt, which is very, very common nowadays, that could take me more than a year's worth of salary, not to pay off, just an entire year's salary is not even enough. Like, even if I didn't spend a single dime, it would take me, 1 or 2 or 3 years to pay that back, let alone if I have to live off my income. So students aren't in the mindset, they're not, they don't have the real world experience to really understand what they're getting themselves into at that point. So it is a problem, and we should find ways to deal with it that are going to remove some of these hindrances here, so for students. So the next thing that I want to look at is a study by Lend.edu. They did a survey. They surveyed a couple hundred people, a couple hundred Americans on savings habits, financial plans. Really interesting data. I will link it in the description below. And they have some charts on there to visualize exactly what kind of Americans are feeling here. But with the coming recession, pretty much all financial experts agree that at some point we're going to have a recession soon here. The disagreement is on the magnitude and the severity of the recession and the crash and what it's actually going to look like. And so obviously, if you've been following me at all, you've heard me say how bad it's going to be, magnitude that's higher than anything that most people alive have experienced today, rivaling the Great Depression, if not exceeding it. So we're in for it here. Because last time it happened, in the Great Recession, they didn't allow the healing to happen. It was basically the government swallowed the bomb and didn't allow the the misallocation of funds in the economic system and the malinvestments basically to be resolved. All they did was they removed the pain, and then they encouraged more of the same that got us into the mess in the first place. And so now, since they did that, this next time that it all starts to fall apart, they're not going to be able to kick it down the road again, kick that can down the road again, and it's going to be a lot worse. So, but the average American doesn't understand this. The average American doesn't understand financial planning personally at all. And so when you look at these stats here, let's see here, only 40% of people say that they feel that their financial situation is strong enough to handle a recession. That means 60% of Americans either said they were unsure or their situation definitely wasn't. And it was 37% of people that said their situation was not strong enough to handle a recession. So that is a massive amount of our population that A, is unsure, or B, is sure that they're not ready to handle a recession. And part of that comes down to savings. So if you look at their data, let's see here, 55% of Americans have less than $1,000 for emergency funds. And 32%, so almost a third of Americans, have zero in emergency funds. So what does that mean? That means if you miss your paycheck, you don't pay your bills. So 1/3 of all Americans are one missed paycheck away from defaulting on all of their bills because they have no safety cushion. Now, again, at the beginning of the video, I talked about personal responsibility and the things that the government and the Federal Reserve is doing that makes this harder for individuals to get ahead and to make good decisions, and those decisions even having a meaningful impact, because $1,000 today might be enough to get you through a third of the month or a quarter of the month, or depending on your situation, a fifth of the month, or where you live. But 20 years ago, $1,000 might have been enough to get you through an entire month, depending on where you live. So yes, the government has had a huge hand in making sure that our money does not go very far at all, and it's only getting worse. However, there's some personal responsibility built in here, and so the fact that a third of all Americans, if they miss one paycheck, they can't pay their bills. This is an enormous danger for our country, because the recession is coming. And when recessions hit, layoffs happen and salaries get cut. And if debt from the average consumer is growing, that means Americans are already spending more than they make. And if I'm speculating here, but I would guess that the average American who is spending more than they make is also the same American who has no money in their savings account. And so when you have a third of all Americans with no buffer zone, when the recession kicks in, some of those people are going to lose their jobs. Some of those households are going to get pay cuts. That means that all of the expenses, all the debt they've built up, and all the expenses they currently have will start to get defaulted on. Well, when that spending has to stop, that's going to make the recession even worse. It's going to have a compounding effect. And this is important here, because this is not a small number. This is 1/3 of all Americans are in this situation. And when you look at what people say about their plan, basically, 12% of Americans said that they are. Let's see. Okay, so when you look at the numbers, 58% of Americans are either continuing to save and plan as usual, or they're unsure about what they'll do if a recession hits. Now, when a recession hits, you have to change what you're doing most of the time. If you're extremely well off, number one, what you're probably doing is you're changing your investments a little bit. Number two, you're probably saving more, or you're purchasing investments that are on sale. If you're not well off, well, you have to spend less. You're most likely getting a pay cut, or your household, at least. If two workers in one household, one of you loses an income. So there are adjustments. And the other thing is, this is not talked about in the survey, but costs are going to go up. And I'll explain why, but costs are definitely going to be going up when this next recession hits. Costs are not going to be going down because we're going to have an inflationary recession. That's the type of recession that's coming. It's going to be an inflationary one. That means prices of goods and services are going to skyrocket. And so people are going to have to start making decisions on what they're going to be buying. They're not going to be able to continue as business as usual. So the people who think they're going to say, hey, I'm not planning on making any changes if a recession hits, or to prepare for a recession, that's just either foolishness or just naivety and ignorance. And so that's, again, not a good outlook. And the more of these things that start to happen, they all kind of have a compounding effect on each other. Because they make things worse. Because as people are able to, not able to spend as much money because they're in debt, they're defaulting on their expenses, they're getting pay cuts, or they're losing jobs. Well, that translates to what the businesses do. Because if the businesses then aren't receiving enough income, then part of what they have to do is increase prices to make up the revenue, or you have layoffs to cut costs, and again, it's a compounding effect on the entire system here. So we're not in for a fun time here. The average American is not prepared, because let's say it was the opposite. Let's say we had a lot of debt, but let's say the average American had a savings rate similar to China. I think in China right now, the average Chinese citizen has a positive net worth of like $33,000. They've got, whereas the average American has a negative net worth. So let's say the average American had $10,000 or $15,000 or $20,000 in the bank account in savings. We'd be a lot better off when a recession hits, because the society overall would have a big cushion. So when incomes drop and bad things start to happen, and trade, whatever it is, whatever the triggers are, the average American citizen would have a cushion to fall back on. And so there wouldn't be this just dead drop off the edge of a cliff. When something pushes you, you just basically fall all the way to the bottom. There would be basically kind of a parachute, soft landing there, so to help everybody get back up on their feet. But that's not the case here, and so these effects are going to compound on each other. And I'm going to briefly kind of explain why we have this situation where it's going to be an inflationary recession, not a deflationary recession. Here's what's going on. I'll make another video about this, but the Federal Reserve just indicated again that they're going to be expanding their balance sheet going forward. That's quantitative easing. Quantitative easing is what they started in after the Great Recession, and quantitative easing is literally just a euphemism for debt monetization. Now, again, so we're right now they haven't made a name for what they're doing, but it's basically quantitative easing. And they said right now they're like, hey, we're not doing quantitative easing. Because they don't want people to think they're doing quantitative easing, but they are. But the only reason they called it quantitative easing in the first place is because they didn't want people to think they were doing debt monetization. Well, what is debt monetization? It's basically the Federal Reserve, which is a central bank, which is supposed to be independent from the government, printing money to buy government debt. So it's financing government spending. That's what debt monetization is. They turn the government debt into money. It's an inflationary procedure to finance government spending. And we've already seen in the good times how government spending has exploded recently, like at record paces. It's unprecedented the amount of money that our government is spending right now. And this is the good time right now. And a lot of people think it's because of the tax cuts. It's not because of the tax cuts. Tax revenue is up from what it was a few years ago. The government is making more in taxes than it was a few years ago. So tax revenue is up, but the amount of spending that they're doing has exploded, way outpaced the actual income from taxes. And so the deficit and the debt is exploding. Well, just like an individual, when a government spends more money than they make, they have to use debt to do that. They have to borrow that money from somebody. So they go out into the marketplace and they borrow money. Well, historically, the borrowers of the people that the U.S. government has borrowed money from has been things like central banks, like China. It's been pension funds, really anybody who buys a U.S. Treasury. That's what you're doing when you're buying a U.S. Treasury. You're just loaning the government money, then they pay you back that money with interest. And so that's how the government finances their spending beyond what they actually make in tax revenue. They just borrow that money from you and me and from other central banks around the world. Well, that's all fine and dandy when people are willing to lend you money. But as you start to borrow more and more, you become more and more of a credit risk, right? Just like an individual, if you borrow more and more money, at some point you're going to max out your credit cards. Well, the government, our U.S. government, has maxed out its credit card, if you will. And so countries that have historically been the biggest buyers of treasuries, in other words, the biggest loaners of money to the United States government, they're not doing it anymore. Russia has dumped record amounts of treasuries, meaning they've gotten rid of that debt. They've sold that debt. They don't want the U.S. government to owe them money anymore because they know that it's worthless. They're becoming more and more of a credit risk. China, same thing. They're selling government debt. They're selling U.S. treasuries at a record pace. They're buying gold instead because gold is nobody else's liability. You have gold, you have gold. You're not waiting on somebody else or some other government to pay you back. And so central banks are dumping U.S. treasuries all around the world. And so the biggest buyers of U.S. treasuries, or in other words, the biggest people who are loaning the government debt, loaning the government money so they could go further into debt, are not doing it anymore. Well, who has to step in then? The Federal Reserve. That's why they're expanding their balance sheet again. That's why they're printing money to buy up these treasuries again, because there's less and less buyers of U.S. treasuries or less and less people to loan the government money. So the only way they can do that is to print money to do that. So that's quantitative easing, that's debt monetization. That's what they're doing now. They're buying U.S. treasuries. They're saying it's to expand their balance sheet or to normalize their balance sheet, but really they're just growing it at a record pace. Another record, unprecedented amounts that their balance sheet is expanding by. And when I say their balance sheet, that's just the amount of U.S. treasuries that they're holding, the amount of debt that the spending that they're financing for the government. And so what happens then? Why is this inflationary? Well, when other countries sell the U.S. treasuries, the Federal Reserve steps in and buys them. And so if the Central Bank of China sells a treasury, they get U.S. dollars instead. Well, if you sell a treasury, which is you're earning money on in nominally, maybe not in real terms, but they're actually paying you nominally an interest rate. You're earning money on it. Well, if you don't want treasuries anymore, which are earning you U.S. dollars, how much less likely are you to want actual dollars that don't pay you any interest? You're not very likely to want that. So what are you going to do instead? Well, you're going to get rid of those dollars, and you're going to either get rid of those dollars and get other currency, or get gold, or get products and services with those dollars. And so when you try and go get other currency, well, what happens when you try and get other currency? You have to go to other countries to do that. Well, what happens when all the countries realize the US dollar and treasuries are worthless? Then nobody's going to give you a euro to take your dollar because they don't want the dollars themselves. Nobody's going to give you a franc or a renminbi or a yen or any other currency in exchange for a dollar because they're doing the same thing. Okay, so maybe you buy gold with it, sure, and that makes the price of gold explode, which a lot of analysts are expecting that to happen soon. But the other thing you can do with it is you can buy products and services. Now, you're not going to go to, again, any country except the United States, because if you try and buy things from Japan in the US dollar, well, they don't want US dollars. They're getting rid of them too. So who's the only one that's going to accept US dollars in exchange for products and services? The American taxpayer, because the American taxpayer is the only person who's required by law to accept the US dollar as legal tender in exchange for products and services and goods. And so when the entire world dumps treasuries and the Federal Reserve prints dollars in order to buy up those treasuries, then the rest of the world would get dollars. And side note here, the reason why the the Federal Reserve is going to print money to make sure that the price of treasuries doesn't drop is because if the price of debt drops, then that means the yield goes up. That means that in order for the government then to take out more debt, they'd have to pay a higher interest rate. So the Federal Reserve needs to make sure that the price of bonds, the price of treasuries, doesn't drop. Otherwise, the interest rate will go up. And they need interest rates to stay low because the government needs to continue to be able to pay for everything they're paying for. And they won't be able to do it if interest rates spike. They won't be able to afford it. They need this extremely low interest rate. And so they're going to have to do that. They're going to have to print money to buy up all the treasuries that the rest of the world is selling. Okay, so the rest of the world gets these dollars. The only people that are going to accept the US dollars in exchange for products and services is the American people. And so when all these dollars start bidding up the prices of these goods and services in order to buy them to get rid of their dollars, that's going to make all these prices explode. So we're going to have this kind of massive pool of all of these really bad things happening all at once, where people are losing income, losing jobs, getting their salaries cut, costs and prices are skyrocketing, debt is being defaulted on, and so we've got this massive trifecta, if you will, of just a perfect storm, really, of things happening that are going to cause the rest of this to boil over. And that's why I've been telling people that you need to prepare, because it's going to get a lot worse than what anybody alive has ever experienced. Because the only tool that central banks have to deal with things like this is to print money. They call it 100 million different things, but all it is printing money. It's expanding the money supply. It's keeping interest rates low to make debt and credit easy to finance and to keep asset bubbles inflated, to keep the wealth effect going. And all that does is cause inflation in the long run. And so we're finally going to see all the inflation we've created, all that money we've created over the last 10 years that's been exported to the rest of the world. It's going to come home at some point, and it's probably going to start happening very soon here. And so that's a background on what the Federal Reserve has been doing recently, on why they just announced that they're going to be expanding their balance sheet again, because they have to be buyers of treasuries. And so just a little bit of a background into the average American here. So if you fit into any of the things that we've talked about today, just understand that a lot of people have started where you're at and moved themselves ahead. It's very difficult to do that right now, but it's not impossible. So I have written a book. It's on Amazon. It's called Financial Heresy, step-by-step plan, regardless of where you are in your financial situation. It provides step-by-step plans to help you move forward and to start to prepare. Whether you're just entering the workforce, whether you're loaded up on debt, or whether you've got a good job and no debt and you want to start making good choices with the money that you're making, or if you have a sizable nest egg, whatever your situation is, I've got practical step-by-step applications in there for you to start preparing, because this crash is going to be bad. And the more people that are prepared, the easier it's going to be. And if you're prepared and all of your family and friends are prepared, then it's going to make it a lot easier. If you're the only one that's prepared, then you're going to kind of be helping out everybody around you. And so the more people that we can get to get ready and to prepare and save and buy assets that are, a hedge against inflation, instead of, things like American stocks or bonds that are going to be crashing in this next recession, the better off we'll be as a society, and the easier it'll be to get through. And so if you are on that side, don't get discouraged. Just realize there's things you can do. Buy my book. And then I have a course coming out soon. It's not available yet. This is just kind of a little teaser. I have a course coming out soon, and it is on trading options. And so if you have an investment account, you can use options to protect your investment account so that if stocks crash, you don't take a hit. There's strategies in there that talk about how to basically purchase insurance on your investments. Strategy in there you might to profit off of the collapse. And it explains, it's kind of a foundational options course so that you can understand if you have a little bit of stock investing experience or mutual funds, but you've never dived into options, this is the course for you. It's got a lot of information and education on basically teaching you the foundational concepts. So it's for somebody who's never ever experienced options at all, to take them from that place to be able to trade them successfully for the introductory basic level strategies. And so I'll have more information coming out about that soon. I'll let you know once it's available. Not available yet, but it's coming out soon. So if you liked the video, please please subscribe, help a small channel out, share it with your friends, and let me know if you have any questions or comments in the comments section below. So I really appreciate listening, and you guys have a great day. Thank you so much for watching. I really hope you enjoyed the content. I try and put out as much content as I can, especially whenever there is something new happening in the market. Please like and subscribe. And if you want more, if you need a step-by-step plan in order to prepare for the coming financial crash, I did write a book. It is on Amazon. You can buy the Kindle version or the paperback. It's called Financial Heresy. You can also find it on my website at heresy.financial, but it's easiest if you just go to Amazon. You can again get the Kindle or the paperback. It's called Financial Heresy. Thank you so much again for watching. Please like and subscribe and share. You guys have a great day.